In this weekend video, I'm going to take a look at some of the longer term multi-year cycles and maybe make a few guesses as to where I think we might be heading in the next year or two. Starting with the stock market, we've got here's our multi-year cycles. We've got obviously one in 2009. I think this was a generational bear market low, similar to uh, what occurred in uh, the crash into 32. I think this is the same thing. I don't think this is going to be violated probably ever. I think the stock market is starting in the next secular bull market. We've got another multi-year cycle low right here in 2011, 2016. Our next one is going to be due if we continue with this pattern of 4-year cycles, which I should note can shrink or stretch. But assuming that we're looking at just a normal timing band, then the next 4-year cycle low would be due sometime in 2020, probably early 2020. So in regards to where we're at right now, um, I do not believe that the S&P is ready to break out on a sustained basis just yet. We're still stretched a little too far above these long-term moving averages. We're getting pretty well. We're getting really late in this intermediate cycle. We're on week 23. Um, I'm going to say we're going to need another intermediate correction. As I've noted in some of my other posts, the opportune time for it to occur would be between the August 1st FOMC meeting and before the September 21st FOMC meeting, where the Fed wants to raise rates again. If the market is going to be allowed to correct, that's the timing band for it to do it, and then they have time to get the market back up to those highs in time for the next rate hike. So we're late enough in this intermediate cycle that I suspect we're about to get an intermediate degree correction here in the month of August. Maybe we bottom the first week of September, but I think it's going to be over and done with in time for the market to be back up near the all-time highs by the September 21st FOMC meeting. You can see we've also got a huge divergence in money flows on the weekly chart. That often occurs as we're moving into an intermediate top. So I really doubt that we're going to get any kind of a sustained breakout at this time. We're still a little stretched too far above these moving averages. We're probably going to have to go sideways, and correct, come back down closer to this moving average again before we can, really have any shot of a sustained move up. So the degree of this correction could determine where we go into the end of the year. We're going to need to create some fuel for a breakout, and that is done not by a mild correction, which would seem logical. If we just get a little pullback, maybe to 27, 50, something like that on the S&P, then we're probably not going to have enough fuel for a sustained breakout into the end of the year. We probably need a bit bigger correction. So, if we get some kind of really severe sell-off that comes back down, maybe back down to this 2600 level, testing the February lows, that would create the kind of fear and sentiment extremes that could power a sustained breakout above this level into next year, which would, in theory, would stretch the market quite far above these moving averages, and then that would set up our move down into the 4-year cycle low in 2020. We would not necessarily a parabolic move, but just a market that's just stretched. The rubber band has been stretched way too far above the moving averages, and then would need a very severe hard correction to work off that excessive bullishness. So, a correction in line with this one, and obviously not anywhere near as hard as this, because, like I said, this is a generational bear market bottom. but something, in line with 2016 that probably drops back down below this 100-week moving average in 2020. And finishing up here with the semiconductor index, I've been looking at this for over a year or so now, and again, I don't think we're quite ready to break out on a sustained level above this 2000 peak just yet. We've made a couple of tries, but they've all been kind of late in the intermediate cycle. We're kind of in that position again right now. We're getting late in that intermediate cycle. We need to break out above this early in an intermediate cycle to have a chance of a sustained breakout. So don't think the semis are ready yet to give us the breakout above this 2000 high. And just like the rest of the stock market, still stretched a bit too far above this long-term moving average. So I believe everything is probably set up for a correction here over the next month or so into late August, early September. Depending on how severe that correction is, should tell us whether or not we're ready to get a sustained breakout and move into 2019, something that could take the NASDAQ to 10,000. So for those of us that want a move to 10,000 in the NASDAQ, we need to see a very sharp, very scary correction in the stock market over the next month and a half. If we get that, then I think we're set up and ready to go for 10,000 NASDAQ in 2019. Moving on to the dollar. The dollar runs in what I call a 3-year cycle. That cycle runs anywhere from 3 years to 3 years and 6 months. Again, sometimes it can stretch or shorten. 3-year cycle low here, one in 2011. Things start to get a little fuzzy here. We've got one in 2014. I tend to think this was a 3-year cycle right here. The reason being is that this yearly cycle low came below the previous 2015 yearly cycle low. So that's kind of a marker that this maybe was a multi-year cycle low here. So this would have been a shortened 2-year, 3-year cycle only lasted 2 years. Then we get the powerful rally up that breaks above these peaks, convinces everyone that the dollar's going to 120, and then instead it rolls over and the 2017 yearly cycle low occurs again below the 2016 yearly cycle low. The 2018, I tend to think this is probably not going to be a yearly cycle low. The 2017 occurred late in the year in the fall. So my best guess is that this is not going to get through this resistance level at around 94, 95. Probably not going to get above this declining 100-week moving average, and the dollar is going to roll over and give us another leg down. And if my count is correct here, if this is a short multi-year cycle low, then the next multi-year cycle low would be due sometime in 2019, maybe mid to late 2019. If this is a short cycle, then this could stretch long. Maybe we stretch into the early part of 2020 on this next multi-year cycle. So a lot's just going to depend on what happens over the next few weeks and the next month. This intermediate cycle is very mature, so it doesn't seem likely to me at this point that a cycle that's already this mature and had gotten this overbought is unlikely to be able to break through this resistance zone, and we're going to start back down here pretty soon. So that's my best guess. And if so, if we start down and it's a hard move down and we break below this early cycle low here in 2018, then that would confirm that my cycle count is correct. This was a multi-year cycle low, and then we would look for the next multi-year cycle low sometime in mid 2019 to early 2020. And real quickly, a look at the euro, because that is the mirror image of the dollar, and where the euro goes, then the dollar usually runs inversely. Again, we've got this very long, very sustained bear market. We've got a slightly lower low here in late 2017, and then we get this powerful move up that breaks back above the 100-week moving average, turns the moving average back up, breaks through this resistance zone here at 120, and now we're getting a corrective move down, and kind of like the dollar, the euro appears to want to hold above this rising long-term average, and is moving out of these extreme oversold conditions. So, again, in the next several weeks, if the euro can produce some kind of an impulsive move back up, then I think that would confirm that this is a final bear market bottom, and the euro has now begun at least a cyclical bull market. And then at that point, we would look for some higher highs above this peak, and maybe above this peak, and I don't know that we would get above the bull market top in 2008, but anyway, we should start to see some higher highs, which we've already seen. We're seeing higher highs above this level, and now we're testing this level as support. All right, CRB, also a 3-year cycle, kind of the mirror image of the dollar, although not always. Sometimes the CRB will disconnect from the dollar. 3-year cycle low here, another one here. Then we get this really stretched cycle, 3-year cycle low here, another one here, long cycle here, short cycle here, 3-year cycle here. This 3-year cycle right translates. The 3-year cycle low holds above the 2009. Then we get a left translated cycle that tops very quickly, moves down, which would suggest that the 3-year cycle is going to break below this, which it does, and I think this is again is probably a generational low in the commodity index. I doubt that we're going to break below this anytime in the near future. This was $26 oil, as you recall. I don't think we're going to go back below that level anytime in the near future. The CRB during this multi-year cycle came up to test this 100-week moving average, dropped back down, was not able to drop below the 2016 low, and now we're commodity index is back above this rising 100 moving average. So I think we are, I guess you could call this a bull market, but it appears that it's going to be a very slow sideways bull market, and we're getting a bit late in this 3-year cycle. The next 3-year cycle low is going to be due in sometime between early 2019 to mid 2019. So while I think we have probably completed the summer ICL in the CRB, we're getting late enough in the cycle that the next rally is likely going to left translate, and so I wouldn't expect the rally out of this to go too terribly far. Maybe we only make it to like 2020 on the CRB before we start moving down into that 3-year cycle low. So here's the Fibonacci retracements. This is the top of the last 3-year cycle. I would think we could at least retrace 38% during this this rebound out of, like I said, what I think is probably a generational low in the commodity index. But I would say the odds are probably not good that we're going to get above that level. So maybe we get to 2020 on the CRB between now and sometime in late in the year, early next year, and then at that point I think we start moving down into the 3-year cycle low. So you can see at the recent bottom a couple weeks ago, the sentiment on the commodity index had soured enough that this could power a move out of an intermediate cycle low. So it looks like everything is set up for the next rally in the commodity complex. Um, but again, I don't expect that it's going to go terribly far. Moving on to gold, we've got at this point we've got a pullback that has, I would say, has created enough fuel for gold to finally break out of this sideways consolidation that it's been in. For the last 2 years, we've hit extremely oversold levels, more extreme than just about at any point in the bull market or even in the bear market. The only time the weekly charts have been more oversold in gold was during this initial crash in the bear market. So I would say the fuel is there. Let me switch over to the sentiment. I'll show you sentiment levels. All right, so as you can see at the bottom or at the low, 1210 I think it was recently, sentiment had reached levels as extreme as just about any intermediate cycle low, even during the bear market. So the fuel is there for a big move in gold. The COTs have, the commercials have reduced their shorts to levels, similar to the final bear market bottom in 2015. So the rubber band has been stretched extremely far to the downside. We should have the fuel necessary for a breakout above this basing pattern, this consolidation zone. Maybe we get to the 1450, 1500 level before the entire commodity index starts moving down into that 3-year cycle low. So the fuel is there for the move. Now, what we need to see is an impulsive move out of an intermediate cycle low. Something that leaves everybody, sitting at the station, scratching their head, wondering, what the hell just happened. If we get that, then I think we're probably on our way. There's a lot of room between these kind of oversold levels and overbought levels up here. Enough room to where we could easily get to 1450, 1500, but we need an impulsive move out of this bottom. If we don't get an impulsive move, then if the rally's kind of tepid, then there's a very good chance that we're going to, the rally's going to be capped in that 1300 to 1310 level, and then gold is going to probably start heading back down, and we may even test these bear market lows when the CRB makes its next 3-year cycle low sometime in 2019. So a lot of this is going to depend on what the currencies do. If the dollar rolls over and confirms that it's still moving down into a multi-year cycle low, then I think that would give us an impulsive move in gold, and that would be the fuel, along with extreme bearish sentiment and extreme oversold levels. That could give us the fuel to finally break out of this, at least to some degree. Maybe we come up and test this resistance zone here in the 1450 to 1500 level in the next 3 or 4 months. So we'll see. Once we get a confirmed bottom, we'll see how the rally unfolds. We need an impulsive move, something that catches everybody by surprise. And if we get it, then I would say we're going to 1450 to 1500. If we don't get it, then traders probably better be ready to get back on the sidelines between 1300 and 1310.